Let's talk the employment report because we got a good one. It's kind of cool. So somehow they worked it out just right. So you have something to work about. So overall, was it a strong report or weak report? Pretty impressively strong. You don't see too many 500,000s, maybe in 2020 coming out of COVID, but yeah, that's a pretty strong number. 3.4. There's some debates on 3.4. You talk about full employment, then you have excessive full employment. So there should be unemployed people all the time because people are switching jobs and all that kind of things. So when you get to 3.4, are you getting to the point where it's going to be inflationary? So you can certainly look that up. You can certainly Google inflation plus versus unemployment rate. There are theories out there. When does employment get so strong that it becomes inflationary? But 3.4, but we still have this low participation rate. It came up a little bit, 62.4. I found an article, I'll have to show it to y'all, asking where did all the men go? There's a bunch of men in their 40s that have dropped out of the workforce. This article says most of them are out there playing video games, but they got to pay their bills. What are they doing? Are they all driving Uber or whatever? But a bunch of men have dropped out of the workforce, and no one's really sure exactly what these guys are doing. It's material enough that it's starting to impact these numbers. So this number might be exaggerated on the low end. There may be people out there that really should be looking for jobs, but somehow they're in their parents' basement or something and they're not working. We don't know really where these guys are going. Private payroll is very, very strong, but it looks like governments were pretty strong too. You can get the details. I gave you the link. I don't know why they put manufacturing on this report because it's not as important as it used to be. Obviously, retail and service is a much bigger part of our economy now. I think just out of a habit. But if manufacturing only added 19,000, where's the other 440-something, 30-something thousand workers? Is it healthcare? Is it education? Is it consumer retail? Where are those? So I'd be curious in that, and your boss probably would be too. Is there one particular sector? Maybe it's travel and leisure. Who knows? Anybody figure that out? What was the biggest one? That would certainly be a very interesting thing. That's a lot of jobs, 400,000 jobs. Earnings, inflation doesn't look all that bad, did it, in this particular report? And when inflation's 8%, but wages are only going up 4%, that doesn't look too bad. The work week jumped. Why did the work week jump? Maybe someone would tell you that. That may not be important. The numbers you're definitely going to talk about is the 517, the 3.4, the 443, the 62.4, and one of these wage numbers, wage inflation numbers. Hours worked, you might put that in, or maybe not. How did markets react? Well, initially, I was thinking, when I first saw it, I thought this can be a sell-off. This is one of those good news is bad news, because a couple of days earlier, Jerome Powell is somewhat hinting that inflation's under control. I won't be raising rates as much. And then you get this incredible jobs report. Think, okay, he's going to have to change his opinion. What do you think Jerome Powell knew about this report on Wednesday? Do you think he's fed some information? I don't know the answer to that, but wouldn't you think he's getting some preliminary data before this thing's released or not? Do they keep it from him? I would think he might get some kind of hints, right? They know some of this stuff before the Friday report comes out. It's not like they're waiting for all the surveys to come in on Friday at 7 a.m. or something. So I wonder what he knew before he started saying that stuff. I hope he knew a lot, and that way we could kind of put more weight into that.
My thought is that it's kind of a game in between, saying he wants a soft landing. So if the employment rate stays low, as long as there's not a wage price, it basically, the fear is that it'll become a wage price.
Well, I don't know if it's even wages. He's just worried about inflation, but yeah, that's the argument is once inflation gets into wages, you're kind of done for, because then everybody's thinking it. But even if just general inflation's higher, he's going to worry about that. You could certainly add to your paper the latest CPI numbers. supposedly Jerome Powell doesn't use that. He uses the GDP deflator, whatever that is. But what number was he looking at to say inflation looks like it's cooling down? It doesn't help that the dollar is weakening. That's somewhat inflationary. So, the dollar being strong kept our inflation lower than everybody else's. But the stock market didn't like it. You somewhat expected that. So we're in this place where, if there had been 50,000 added, the stock market probably would have rallied pretty strongly, just saying, well, now Jerome Powell's gonna be worried about a hard landing, so he's gonna have to cut back, and they're more worried about him than they are the economy weakening. But 1%, that's a pretty big day, but I gave you the pattern. So I was kind of shocked. I remember talking to someone, it's like, I'm surprised it hasn't sold off more, and then it kind of sold off there at the end. Tech stocks sold off more, but they're the ones that have been rallying here recently, especially Facebook last week. Pretty crazy on Facebook, and Facebook has held up since then, even with these numbers. 1.6%, so tech stocks. We'll talk later. In fact, we might get to it today and definitely by Wednesday. Tech stocks, do you think those are value stocks or growth stocks? Any guess on that? Growth stocks. Growth stocks traditionally, there's some debate on this, but traditionally hate high interest rates. And why is that? Because so much of their values way out into the future. When discount rates go up, their values. So we kind of think of them. You might think this is a strange thing to say because you're probably thinking duration only applies to bonds, but you can say growth stocks have a higher duration than value stocks. They're more sensitive to interest rates. And so if it looks like the Fed may have to raise rates more because of this strong report, that's going to hurt tech stocks and growth stocks more. Small cap did okay. So what is small cap? So small cap is less sensitive to interest rates and more sensitive to the economy. So small cap is like, why do we care if interest rates go up? But if the economy is strong, we get a soft landing, that's great. So small cap hate weak economies, so they tend to be okay with the good news. It still fell 0.8%, but not as much. Oil, why was oil down so much? That's an interesting one. That's one I'm not sure about. Will you talk about oil in your paper? I don't know, you have to decide, but that's a pretty big drop in oil, 3.5%. Have y'all seen natural gas the last few days? My word, it's back down below 3, and it's just why? Because Europe's supposedly having a mild winter, I guess. So maybe that's complete. So be careful. If you talk about oil, did oil react to the jobs report, or is something else going on? Something looked like something happened right here, but who knows? I didn't follow oil. Gold, you would have thought gold would have been up on Friday. So gold has been the strange one. So we think about gold as a protection from inflation, but it's been a horrible protection from inflation. Last year is actually down. You would have thought last year would be the perfect place. So what is gold actually reacting to? US dollar. US dollar was strong on Friday. Why? Because the Fed may have to raise rates more. What is gold hating? Gold loves inflation, but it hates a strong dollar. So we saw that last year. Gold was just terrible last year. Should have been your protector. But the US dollar was so strong last year. Gold just had a horrible year. So yeah, why did gold? I think gold was reacting to the jobs report, and it reacted by seeing that the US dollar was so strong on Friday. And it makes sense the dollar would be strong. Strong employment report and probably higher interest rates. What did the Treasury do? So which two of these three numbers will be in your paper? The first one, what about that one? Yes, what about that one? No, this number should not be anywhere in your paper. That number makes no sense. I don't know why Yahoo Finance puts it in there. So the yield finished above 3.5%. That's been somewhat, you saw it today. I think it got up above 3.6. So 3.5% is back up about 3. How much did it move? 13.6 basis points. Is that a big day, small day? Pretty big day, almost 2 sigma events. So pretty big day. You would expect interest rate to be up. What did Treasury prices do? fell pretty dramatically, right? That's why that 4% means nothing. It should be in red. So yields were up for 13.6 basis points as the bond market sold off. Why? Strong. This you expect. All right. So you saw a day when both stocks and bonds sold off. When does that happen? People are worried about inflation. Gold's the one bizarre one where it was also down, but that's because of the strong US dollar. So you've got a mixed bag. But usually strong economic report, stocks are up, bonds are down. Not this time. Why? Because people are worried about inflation. So when it's kind of obvious, it's a big day for both, right? Stocks down over 1%, yields up more than 6.5 basis points. Big down day for both stocks and bonds. That almost always means inflationary fears. Almost always. And that's a pretty big day. And the initial reaction was, I mean, they just shot up and stayed up. It wasn't like there was some uncertainty about that. So a pretty bad day for bonds. Here's what the stock market did. Apple had a great day on Friday, but that was specific to Apple. Pharma had a good day. I don't know why. I don't know why Exxon would have been up with oil prices down. No telling on that one. So that's kind of strange. And CVX. Banks looked like they did okay. I don't know why Citibank was down a bunch. Retail, Amazon was down. How did Walmart do? Walmart was down. Costco was down. So there is a lot of grain in there, but the red is pretty dramatic. And Apple, remember, Apple's the biggest stock out there, and it's up 2%. So, it by itself added 0.1, 0.2% to the index return, and the index was still down over 1%. So if it hadn't been for Apple, the index would have been down like 1.15 or 1.2. So, when the biggest stock is up 2.44 and the market's down 1, somewhat of a bizarre day. Y'all know why Apple was up on Friday? Did they announce something? Yeah, we've had some earnings reports come out. So, Meta was down on Friday, but not down as much as the tech stocks, and it's actually been kind of holding its own today. And then, just in case there's something you want to look at specifically, so yeah, gas prices, crude oil, a lot of natural gas, a lot of energy prices were down on Friday. So why is that? You had a strong dollar. Is a relationship between energy prices and the dollar? Is there a relationship between energy prices and interest rates? Is there a relationship between energy prices and gold? Those are all really interesting questions. There are relationships, but they're not real stable. But you have to kind of think through that. What was energy reacting to on Friday? Was it the dollar? Was it the jobs report? Was it interest rates? Was it gold? What is that reaction? US dollar had a really strong day, up 1%. Nothing else here. I don't think y'all see anything else you could bring into your paper. The VIX was up, but not much. You would expect the VIX probably to be down on Friday because you got that new information. So you don't have that uncertainty on the jobs report, but it still increased. So somehow even getting the jobs report created more uncertainty and the VIX rose a little bit. 30-year bonds were down more than 10-year bonds, as you would expect, more duration. See, the 10-year bond was down almost 1%. So both the stock and the bond market were down 10%. This is price here. So this is not yield. So always be careful on treasuries. Are we talking about yield or price? Here, they're talking about the price. The 10-year treasury is down 1%, just like the stock market. You got gold in there somewhere, sugar. I don't know if there's anything else in here particular you would talk about. Gold and platinum. Platinum was down 5%. And silver was down 5%. I don't know why they're down so much more, although gold is probably a more protector from inflation than those two are. Y'all see anything else that jumps out? Are you going to talk about orange juice in your paper? Probably not. Probably has absolutely nothing to do with the jobs report. So don't bring something else in just to bring it in. It needs to be related to the jobs report. And then the EMI, January was very disappointing, but pretty essentially ignored. Why? Because it came in when Jerome Powell was talking. Y'all know the PMI. So what does 47.4 mean? It's actually a fairly simple report. Anybody know the PMI? Y'all follow that in your eco class or money and banking? So they're going out to purchasing managers. These are people making decisions over the next 6 months. If the things are doing well, they're going to be bullish. If things are going badly, it's essentially a survey. And the way I interpret the 47.4 is how many were positive, how many were negative. If half are positive, half are negative, they come in right at 50. If more are positive, you'd be 51. If more are negative, 47. 47 is below 50%. So that implies a shrinking economy. What we know for sure, though, is historically, when this number hits 43, the economy is actually going to shrink. So we're not in a shrinking economy yet. We're in a slowing down economy at 47, but it is dropping. I don't know if they give you a graph in here, but it's definitely dropping. And then here's the chart you often see a lot with the index. It is a manufacturing index. You might think, well, why don't we use the service index because we're 80% service, but the manufacturing is still the more important of the two. I didn't look at the service one. I don't know how I did. You might look at it. But the most important number in here is the new orders. You can see the new orders fell to 42.5. That is a horrible number. The PMI is definitely saying, hey, we've got some issues going on here. Now, if you put this, I'm not saying you should put the PMI in your paper, but if you did, let's say, hey, Friday's report is really strong, but we did get some negative news this week. The PMI came in pretty weak. If you put this entire chart in there, I would highlight something. Don't just give your boss a bunch of numbers. You can see the trend on new orders has been down pretty strong quite some time. So definitely contracting. Look at that, contracting, growing employment. We just saw that. Decreasing, contracting. So yeah, it's the PMI is telling you got an issue. This is one of the leading economic indicators that the Federal Reserve uses, or the federal government uses to forecast whether we're going to have a recession or not. What else did we see this week? I didn't look at this one. Jobless claims. Can you see 2020 in there? Pretty amazing number, wasn't it? We've never seen a number like that ever in history, just off the page. This is January 28th. Was that last Thursday? No, what was last Thursday? February 2nd? Yeah, so I don't remember what that number was. Initial claims was 183, a decrease of 3,000 previous week. The 4-week moving average is what they really look at. It was slightly down from their previous week. So jobless claims, not real material. What else might you look for? So the JOLT report, have y'all seen the JOLT report? Unfilled positions, the quit report, that's been big in the news. Those are kind of things you might look for. You might see them in articles. Is there anything that gives you a bigger picture on what's going on with the economy? Let me see if I can find this article real quick and I'll show it to you. I didn't. I don't know if I can find it. Well, maybe next class I'll remember and show you. But yeah, it's talking about the fact that there's some strange things going on here. So a bunch of middle-aged men have dropped out of the workforce. What are they doing? Where are they? Is there evidence more and more people are retiring? Because that's what's going on. So there is some evidence that people that were nearing retirement, didn't plan to retire, and then COVID hit, and they said, you know what, I'm out of here. That's having some impact. So that participation rate is pretty important. So if you're looking for something, what I'll do is I type in what I'm looking for, participation rate, and I put the word Fred. Who is Fred? Federal Reserve, St. Louis. And so labor participation rate, the Fred, and you can see it's still much lower than historical levels. So we talked about this earlier. Why is it going up here? Women join the workforce, flattens out. What's going on here is that baby boomers retiring. It really, there's not enough data. There is some data that it's disability. So I don't know, y'all talk about Social Security and Medicare, you're worried about them being bankrupt, but Social Security disability already is bankrupt. Because there's so many people on disability, disability is actually impacting this number. There's people who are out on disability that are causing this job. That's kind of scary, isn't it? And then there's COVID. See, it dropped down almost 60. It's recovered, but it's still well below. I mean, just look at the trend. We're just well below. Where are those people? You don't have that many choices, do you? So we keep talking about the baby boomers retiring, but I don't think that drives that entire thing.
Remember that summer, 2021, when nobody was working, they were getting stimulus checks? That maybe have an impact?
Well, that's probably what's going on in here. This is the
the
participation rate. So this isn't unemployed people. This is people saying I'm not looking for a job. So that's possible.
That summer I worked 3 months straight without a day off.
Well, I mean, the jobless benefits were coming in here. It might have kept it from coming back up as strong as it might have. A lot of those have gone away now. I don't know, how much that was and how much that influenced. I think a lot of retail people are thinking, why would I go and get sick if I can get job? I can kind of understand that. But yeah, that's the kind of thing you're going to find. I'm not an economist. You got to find articles that can give you some indication on what's going on here. I remember my barber, when Supercuts opened up, I left him a big tip because I was like, hey, she showed up. Only person showing up. I really needed a haircut. So.
And I talked to people from traveling. Six Flags, some of that would take an hour or 45 minutes just to get off because nobody was working.
Yeah, no one's working. Yeah. Well, that's, it was an unusual situation. So now the question is COVID still impacting these numbers, or is something else going on? And if I remember to show you the article, I have it on my my emails, but a few days ago, so I won't go through my millions of emails. So you have quite a bit to work with here. Interesting things going on. If you want to get really into it, then Hoisington, he has some stuff to do to say. This is his fourth quarter 2022, so it's a little dated, but he talks about the supply of money quite a bit. Talks, he starts out right there with the monetarist Milton Friedman right off the top. He gets a little complex, but he has a lot of really interesting things to say. Is the economy going to heat up? What's inflation doing? That's his thing, because he bets on treasuries. That's all he buys. He's really unusual. Most bond investors buy corporates. He buys nothing but treasuries, and he bets on one thing, and that's interest rates. He bets on whether interest rates are rising or falling. This is not Hoising, this is Lacey Hunt. He writes this, but really, and he has some great charts that I find very, very easy, very interesting. One thing I, always remember, because I think it's probably, to me, the most important formula in economics. Let's see if y'all remember this. Are y'all taking money in banking now? You are, so y'all tell me what this is. Y'all learned that formula there. I use this formula all the time in my thinking. So anybody know? What's the M, Dante? Money supply times the velocity of money times price times what? Quantity. You remember that formula? I just love this formula because what does that mean? Well, people back and Lacey Hunt has a great article where he really kind of badmouths Jerome Powell, but money supply was just skyrocketing because of COVID, and we had no inflation. Why is that? Well, if money supply increases and velocity stays the same and the quantity stays the same, what has to happen? You have to have inflation. But we didn't. Quantity didn't increase, price didn't increase, but money supply increased. So what must have happened? Velocity just nosedived. Why? People are just sticking the stimulus check into their checking accounts, just sitting there and no one's, because why weren't they spending money? Like, where are you going to spend money? Like, government, here's a bunch of money, go spend. It's like, okay, the restaurants are all closed, can't go to the theater. I'm eating at home, so I'm saving money there. It's like, where do you want me to spend money? And then we came out of COVID, and what happened? Velocity took off, inflation took off. Quantity, what did it do? We had supply disruptions, we had war in Ukraine. You see why inflation took off so much. We had all that fuel and money supply, velocity took off. These people coming out of COVID didn't have the quantity because of all the supply shocks. So it kind of makes sense when we had that. Jerome Powell said, I'm not worried about the money supply because we haven't seen any inflation. And he kind of got surprised there on the other side. So you have quite a bit to work with, but I always remember this formula because it's just so critical to understanding just the nature of finance. So the nature of economies. All right. So on the paper, you're going to talk these numbers. You got to make sure you talk the actual number, what was expected, the prior. You might even talk to prior revised, or here was pretty material. So why is the prior revised important? Well, you'll notice, and I don't know why this is, you think the economy can fix this, but when the economy is strong, the revisions are almost always positive. When the economy is weak, the revisions are almost always negative. That's a pretty significant revision, isn't it? 223 versus 260, they added, so suddenly 37,000 jobs came up. Yeah, the prior is what they reported, the prior revised is what they're saying it is now. So they revised it up. Yeah. And private is just amazing. So they must have revised down government because the prior private got adjusted by 49,000. All right, so you'll talk all these numbers. You don't always get consensus on like participation rates and those kind of things. So you look at it. So the inflation numbers were in line with expectations. So it doesn't look like they were reacting to the inflation numbers here. They were really acting more than anything, they're reacting to this 517. They tend to react more to the 517 than to the unemployment rate, though. That 3.4 is a pretty incredible number. Do you want to add graphs? Yeah, you certainly could. I just showed you one graph right there. You could certainly do unemployment rate spread and get that number and just see how much we have recovered. Now, is that the lowest ever or the lowest in 50 years? What are they saying? I can't remember. I think 50 years would be 70s, 72. Boy, it sure seems like unemployment was really high in the early 70s because of all the crisis and everything. So I don't know. You can go back. This looks lower to me, 2.5. So it's not the all-time low. 70 years would be right here. There's a 3.5, 3.4. So yeah, that looks like the lowest we've had in that period of time since really late 1960. And then the nice thing about the FRED is that they put the recessions in there. So you can see how, you see what I was talking about is unemployment is a lagging indicator. Can y'all see that here? Recession and then unemployment maxes. A recession, unemployment, recession, unemployment. just very consistent. Unemployment is a lagging indicator. 2020 is kind of unusual in that everything happened all at once, all in 1 week, but definitely a lagging indicator. So you have quite a bit. Fred is really, really good. If you want to, you can dump it into an Excel spreadsheet, or you can just take this and make a picture of it and put it into your paper. That would be perfectly fine as well. The nice thing about downloading it is that you might want to see what's happened since COVID. So the large decrease or whatever you want to do, and to show the numbers. The other thing you could do is you got to do the market. So remember, you have to do the S&P 500. And you have to do the 10-year treasury. Those two you have to talk about. Then you want to add some other stuff. So what else do you add? That showed you a few things, like jobless claims didn't seem too exciting. PMI seemed exciting, but was being ignored because of Jerome Powell. Things like JOLT and quit rates and those kind of things might be interesting. The recent inflationary numbers, they may be old, but that you might be quoting that. You might quote Jerome Powell from Wednesday, but remember, anything you do that's not on Friday, you got to set up why you're talking about it, because your boss only asks you to talk about what happened on Friday. So you have to say, hey, to put a little more context to this, on Wednesday, Jerome Powell said this, so the market was thinking about that going into this report. Something set it up to why you're talking about something that your boss didn't ask you for. All right, so I gave you some stuff to choose from, but you can find some other stuff in there as well. Any questions on your paper? So if you've never written a paper for me before, which is most of y'all, if not all of y'all, except Dante, I guess, has. I don't think any of the rest of y'all. So if you're unsure, come meet with me in office hours with a draft. So what we will do in class is if we get a volunteer, the week the paper's due, someone will volunteer and give me their draft. I'll grade their paper in class. So you can watch how I grade and see how I go through it. I have to have a volunteer. I had a volunteer last time. He actually volunteered 2 papers in a row. So he had the guts to volunteer, but he came and talked to me first. So even though I didn't show the name of who wrote the papers, I want to make sure. So he sat down, we went through it and worked with him. He was the one where he had 2 paragraphs that we were able to cut down to 1 sentence. So you can really get much more efficient with your wording. So I worked with him to try to get him just communicating a little more efficiently. So y'all think about that. You want to be the person whose paper is graded. All right. Are ready to talk stocks, equities, stocks? All right, so when you talk about stocks on the exam and in real life, you've got to set up stocks on what they are, right? And stocks are what Warren Buffett would say, they're simple but not easy. And stocks are very, very simple. When you buy a stock, what are you doing? First of all, you have ownership in the firm. You actually are part owner. If you buy 10 shares of Apple, you're a 0.00001 whatever % owner of Apple. So you're one of the owners. You have the right to vote your shares. If you don't like management, you can vote them out. If you can get other people to vote with you. So you have ownership. So what does that mean? Well, you share in the good and the bad. So let me show you how simple stocks are. The return on a stock is its current dividend yield plus its earnings growth. That's what you expect the stock to make. It's that simple. Really, really simple. Now, there's one other thing called repricing, but that's complete speculation. Had a student catch me today before class. Do you think the economy is going to have a hard landing or a soft landing? It's like, I don't know. I don't forecast stuff. I don't know. That's not the way I think. I think, what happens if it's a hard landing? What happens if it's a soft landing? What if happens, what's going to do well, what's not? I'm going to make sure I've got my bases covered. Because one thing I know about the future is that I don't know what it is. So I'm like, but that's what a stock is. You're taking its current dividend yield plus expected earnings growth. Seems too simple, but you'll see this on papers 3 and 4. This is exactly what you're going to do. Now, I've always had heard that So one day I said, you know what? I wonder if it's even true. I'm going to test it. So I went back to 1871. When you see 1871, one name comes to mind, and that's Robert Siller. So he's the 1871 guy. If you see 1922, that's Roger Ibbotson. So these two people have come up with these data series. I don't know how they've done it because the S&P 500 hasn't existed that long. What stocks were in the S&P 500 in 1871? Some bank stocks, maybe a railroad. I don't know. Most retail was these small shops. You know, you had blacksmiths. I doubt many of them were incorporated. So I don't know what was in the S&P in 1871. It's kind of, so I don't know where he got these numbers and figured them out. But anyway, the Dow Jones does go back pretty far, but I don't know how you got these numbers. But what I did, this red line is each decade. And what I did with each decade is I took the yield on the stock market plus the earnings growth for that decade. So stocks make you dividend yield plus earnings growth. That's exactly what that red line is. The blue line is the actual stock market. So you can see the first few years it followed it pretty closely, didn't it? Then you have the roaring 20s. What happened after the roaring 20s? You had the Great Depression. Then it came back to the line. Then it followed it pretty well, got a little bit above. Then you had the sell-offs in the 70s. Then you had the dot-com fiasco. That corrected, but didn't come back down to the line. Then you had a 2008. Then it came back to the line. First time it came back to the line in like 20 years. What has it done since then? You can't even see COVID in there, can you? So we're well above that line. So what does that mean? It can mean a few things, but overall, I think the red line is a pretty good predictor until right here recently. So I've got a few theories. One is that stocks don't make dividend yield plus earnings growth. It's something else, but I don't know what that other thing would be. Number two is the stock market's grossly overvalued. That's certainly possible. Number three, and this is part of my theory, is this is a very different world than this. What do we know about here? There's two things I think are really critical. First of all, buying stocks was extremely expensive back then. I don't know if y'all know, in the 70s, y'all trade now for zero, no commissions, free. Y'all know back in the 70s, not in today's dollars, but in 1970s dollars, so it'd be, you know, multiply by 4, it was $40 to do a trade. Can you believe that? You call your broker, there's no internet, you call your broker, you want to trade 10 shares of a stock, they're going to take $40 for them to do that for you. Very expensive.
Oh, Jimmy Carter here, right, or that?
Well, he's the late 70s. Yeah, you know, Nixon, Ford. Bernie Madoff's way after that. He's more the 80s and 90s. I don't know exactly when he went over. Well, the 70s, so Vietnam is in this time, but I don't know if Vietnam affected the stock market much. It really, the oil embargo more than anything else, but stocks did get a little expensive in the 60s. And then you had the two big bear markets in the 70s. Coming out of the 70s, people were like, why would anyone ever buy stocks? There was a very anti-stock. That all corrected in the 80s and 90s. Well, Reagan's here, and Clinton and Bush definitely coming out of that. Yeah, I don't want to get too much into politics. That was my, that's when I grew up in middle school and all that. I still remember a band concert where Nixon was resigning and they stopped the concert to play his press conference. I thought that's kind of bizarre. So who knows? You know, you say Reaganomics and deregulation, but Carter was deregulating too. So it's hard to know who caused what. You can talk about Carter's inflation, but then that was really the Federal Reserve, you know, so who knows? You can make all kinds of argument. They say hindsight is 20/20, but I don't think that's true. I think even with hindsight, we're still pretty clueless what caused what. But definitely we coming out of the 80s, in the 80s, doing very, very well. And then the dot-com, I think most people think the dot-com was a bubble. A lot of this right here was tech stocks. If you look at the S&P itself, it did not rise like that. If you take the tech stocks out, S&P was pretty kind of mediocre. And if you look at small caps, they were like sideways. So this really was just a few tech stocks driving the market up. They corrected very dramatically, and we came back. So we go back to the line. So, all right. So so one of my reasons is it was much, much more expensive to buy stocks back then. Which means today you're getting more return just because you're not having to spend so much money for stocks. Management fees are lower, trading costs are lower. A second thing we had is we have a lot more information today than we did back there. Back here, you're buying a stock. Let's say you're buying Coca-Cola. You're going to get an annual report mailed to you months after the end of the quarter. You don't have a computer, you don't have information, and then you get an annual report, and what are you going to do with it? You're going to sit down and analyze the company. I mean, it's just really old information by the time you get it. And so not much information. Now we have a lot of information. What does that mean? Expenses are lower, risk is lower. I think part of this, especially right here, could be a one-time adjustment for lower expenses, lower risk, which means you get a one-time adjustment and then these two lines just go parallel going forward. That could be one argument. So is it overpriced, or is it just we're correcting for these wonderful last 2 decades? I think it's probably a combination of the two. You can certainly load Robert Shiller's charts and look at them. They're out there for free. You just type Robert Shiller data. You can get it for free on the internet, and he'll show you how expensive or cheap stocks are. He still thinks stocks are expensive. In fact, the only time I remember him saying stocks were a good buy was like for 15 minutes right here. And then he went back to their expenses because they bounced off and came back pretty strongly. So I do think that's what stocks give you. And I do think stocks are probably a little expensive now, although I do think we have a one-time adjustment. So I do think going forward, that's what you're going to get. So if that's the case, stocks give you dividend yield plus earnings growth, then how do you forecast earnings growth? And I'm going to make the argument that corporate earnings should grow about the same speed as our economy. Some people say, oh, but don't corporate earnings grow faster than the economy? But they don't, and they can't, because if they grew faster, if our economy grew at 6% and corporate earnings grew at 10%, then in 20 years, there would be no consumers and no government. We'll have nothing but corporations. If there's no consumers, how are corporations making their earnings? Kind of, is it we just have a bunch of robots and AI buying stuff, and we're all just, we don't exist anymore. So corporate earnings have historically been a very consistent percentage of our economy. All right, so let me actually show you the numbers. So this green line is our economic growth. You can see 2020 in there. There's economic growth. The red line is corporate earnings growth. The purple is 5%. The reason I do that is just to show you corporate earnings has pretty consistently had 5% or greater growth. The kind of light blue line is the 10-year Treasury yield. The reason I put that is Dr. Damodaran says corporate earnings should grow about the same as the 10-year Treasury. Now, I don't know what he was saying when the 10-year Treasury is at 0.5%. That was going to be his long-term view for earnings growth. But I put that in there. You'll notice corporate earnings have not grown as fast as the economy until just here recently. They caught up all in 1 year. And now they're coming back down a little bit. Now, how is that possible? How can corporate earnings grow at a slower rate than the economy? Well, this is the S&P 500. It's not every stock, every corporation out there. There's a lot of private firms, but even more important, there are small companies. So the S&P 500 are bigger companies. Small companies probably grow their earnings faster than big companies. So there's a few other companies out there that are probably pushing it back up to the line. But yeah, if you think our economy is going to grow 6%, your forecast for the stock market earning growth is going to be around 6%. It's not going to be 9 or 10. It's not going to be 2 or 3. It's just not going to happen. So earnings growth should tie to the economy, which that raises a question: how does the economy grow? Where does economic growth come from? Well, inflation, labor, and productivity. Dante, you saw these charts last time, right? In my class, I think I showed them that class too. I love these charts. So where does economic growth? Why do I have inflation in there? Well, because that earnings growth includes inflation. That's one thing people say about stocks is, well, if inflation takes off, earnings will go up. It'll be somewhat protected. So stocks may give you some protection from inflation, at least in the long term. Short term, they sell off with inflation, but long term, they do somewhat catch up with inflation. And then you have labor growth and productivity. So let's look at inflation. There's the 70s, wonderful inflation of the 70s. I read Volcker's memoirs. He came in as the Fed chairman to fix all of that. Very, very interesting. Came down, but it was still pretty high. If you look at that, see what you're looking at, 3 to 7, you're still looking at 4% inflation. I still remember at UTSA, I was doing forecasting in the 80s. I remember one year people said, hey, let's assume inflation of 5%. And everybody's like, 5%? Wow, that's just way too low. Can we really go that low on inflation? So back then, 5 sounded like a really, really low inflation number. If someone told you to assume 5% inflation a couple years ago, you would have said, wow, that's way too high. Now, who knows what, because the numbers are all over the place. But inflation, you can see, has really, really, really calmed down and been in that 2% range fairly consistently since then. So historically, inflation's been about 2%. These are medians, not averages. Why didn't I use averages? Because the 70s would have skewed the average up. So 50% of the time, inflation's been, above 2% and 50% of the time below 2%. What about labor growth? So labor growth, 1%, 1.5%. Here you have all these military guys coming out of the war, getting their college degrees, joining, and then you have women joining the workforce, the economy coming back, and then the decade of the 2000s, the first decade in US history where we actually had fewer workers at the end of the decade than when we started the decade. Pretty scary decade. Why is that? Well, we probably hired too many home builders and bankers, and they had to go somewhere, so we just lost them. But since then, look at that. Labor growth has only been about 1% since then. Pretty weak labor growth. Historically, labor growth's been about 1.5% long term, but the last 2 decades, probably barely even 0.5%. And then the single most important one by far is productivity. Productivity defines how wealthy we are and how strong. So if your economy is only growing because you're adding more people, that just means you have a bigger economy and you're sharing it with more people, so you're not any better off. If your economy grows and you don't have to add any workers, that's a wonderful thing. You can pay those workers more. So this to me is probably the most important number by far. You can see 2%, 3%, 2%, 1.5%, 2%, 2.5%, and then this last decade, 1% productivity, one of the worst, if not the worst productivity decades we've ever had. And why is that? That's a really hard question to ask. It's not just the United States, you see it around the world. An article I encourage you to read, and if I can find it, I'll let me know and I'll send it to you. But the last year of President Obama's presidency, The Economist asked him to write an article. And he wrote an article, and his article was about what are my biggest regrets, and productivity is what he talked about. So one of my biggest frustration is why has productivity been so weak in the United States? And then what his solution was. His solution was education, job training, those kind of things. But interesting that he would pick productivity, but presidents, politicians, they understand productivity is where raises come from, living standards come from. That's the strength. Why would productivity be so weak? So some people are really struggling, like, didn't we get the internet, robotics, AI? Didn't we pick up all this stuff that should have made us more productive? What, say it, Okay, so the Fed, good question. It's fairly simple the way they do it. I don't know where they get the numbers, but they take the change in real GDP, say that's 2%, and they take the change in hours worked. So when you do that, change in real GDP, let's say that's 2%. Change in hours work, that's the one I don't know where they get that from. Let's say that's 0.5%. So what is productivity? Productivity. 1.5%. So we grew 2%, we only added 0.5 workers. We obviously got more productive. We got 2%, but only had a few extra workers. We added 1.5 productivity. All right, so it's a fairly simple number to calculate. I just don't know where they get hours worked because I never reported my hours worked when I was at USAA, except for I was on overtime. But when I wasn't on overtime, I could work 70-hour weeks and no one knew. So I don't know where they get this. Yeah, but where they get that, I don't know how they get it because so many workers don't track their time. I mean, I had one 90-day period. I worked every single day, Sunday through Saturday. And I was up there at 6 a.m. till midnight. I mean, you have those years, right? In finance, you're going to have those ridiculous weeks. But no one asked me how many hours I was working. My boss didn't care as long as I got everything done. And that's a lot of workers. So I don't, when they say hours worked, I'm not really sure. Maybe they're looking at hours worked at just a certain segment and they're assuming that applies to everybody. I really don't know, but that's how they come up with the numbers. But yeah, it is somewhat of a mystery. You would think productivity would have been a lot stronger. Now, a few arguments people make. First of all, is productivity really that much greater today than say when we first got electricity? What would have made you a more productive worker? AI or getting electricity? I would think electricity would make me much more productive. Have y'all been in an air conditioned building in San Antonio in August? What would your productivity be? I would be out dead on the floor. I would be completely useless. Air conditioning is a huge productivity gain. That I just showed you the job participation rate. I could dump it into Excel, make a graph. I could do that in a few seconds. When I graduated from college, that would have taken several months to have done that one chart. So it's pretty impressive what we've done in the past, airplanes, cars. So some people are like, wow, we should be so much more productive because computers and the internet and all this. And you have to think, is that really all that impressive versus what we were doing early part of the last century? So that's part of the argument. But here's my argument. What I think is going on is the most productive parts of our economy is manufacturing. You should look at the numbers or how much steel we're producing today versus how many workers we need to do that. It's amazing how much more we're producing today with fewer workers. And we've squeezed so much productivity out of manufacturing. There's not much else to get. Then you go to the service side. So where does productivity go from the service side? Have y'all gone to a McDonald's that only has kiosks? Does it work? You're going to go back? Do you like that? No workers at all? Is that more productive? So there's two industries that are terribly unproductive in the United States. And you know what those two are? The two worst productivity. You're sitting in one of those industries, but what are the two most unproductive industries in the United States? Not maybe. What? School. Education. And the other one, I hope you're not in the other one. Hope you don't have a reason to go to the other one. No. Although private prisons are pretty unproductive, but no, healthcare. So education and healthcare are horribly unproductive. And they're the fastest growing part of our economies. Why is that? Well, I think because they both have horrible incentives. So I volunteered in public schools for quite some time, and I was kind of shocked how horrible the education was and the amount of resources being poured into it. They were hiring all these counselors. And so I thought, great, I get this kid going to go to college. He's a really poor family. His dad was in prison. So it's like, this is great. He's going to go to college. We're going to save this kid. He just needs some scholarships. So I go work with the counselor. She didn't want anything to do with us. She did nothing about college. I was wasting her time. It's like, what does she do all day? So, but that's what schools have been doing. That's been one of the questions is employment and public education has mushroomed. And yet we haven't hired many new teachers. Where's that? Who are you hiring? Who are all these people? Same thing at colleges. We're hiring all these extra people and they're not in the classroom. So why is education so unproductive? That's a good question. Do you think 10 years from now, students will be doing what you're doing right now? Are we going to see a radical change in education? So I don't know. We'll see. Be interesting. Healthcare, why is healthcare so unproductive? Because it's incentivized to be unproductive. Because insurance pays for most of it. So you go to the doctor, you don't pay for it, so you're going to overuse it. Insurance companies don't care because they're a cost plus business. So if you spend more, they make more. Doctors love it. They want to treat you for all kinds of stuff, and probably 30, 40, 50% of Medicare is just wasted money. Why? Because that's the incentive. So those are the two industries I think are dragging, I'm going to argue, are dragging this number down dramatically. There are people who think that the number is just miscalculated. That could be part of it. I know the country, I think, is Nigeria. They changed how they calculated their GDP because they had kind of this hidden economy. And when they did that, their economy just mushroomed, like doubled in size. So is it possible we got a bunch of our economy that's not being counted? It's just out there and we don't know. Probably not in the US as much as say in Mexico or in other countries where they have more of a kind of a hidden economy to avoid taxes or whatever. But there may be some of that. Who knows? But it's a mystery. It's a really interesting mystery that your generation is going to have to deal with. I do think education and healthcare need to be radically disrupted in pretty amazing ways, but who knows what that's going to look like. I think Chat GPT is going to have a huge impact on universities. All right, so you're going to have to handle this in your paper 3 because you're going to figure out the expected return on stocks, which is essentially, in my opinion, a forecast of inflation, labor growth, and productivity. Labor growth, if the baby boomers all start retiring, labor growth is going to be 0 unless we start having a lot of people immigrate into the United States overnight. So you've seen labor growth in Japan is negative, very aging population. The whole world is aging. Even China's having a problem with aging population. So India is one of the countries that's still growing. There's a few countries around the United States that are still growing, but essentially people are stopped having babies. It's kind of, I think, pretty hilarious in Japan is what can the government do to have people to have more babies? They're talking about daycare and those kind of things. That makes sense. But, if you say, hey, we'll give you $1,000, you have a baby, you're like $1,000, give me 100,000. You're talking about raising a kid. That's a lot of work. $1,000, that's not much incentive. You either want kids or you don't. Is $1,000 be enough to set you over the top? So the low birth rate in the world is going to have a huge impact on these numbers. What's going to replace that? Well, you hope productivity replaces it. So is it possible this number will go to 0, but this number will jump up to 3 with AI and robotics? That's what's happening in Japan. Have y'all seen kind of some of these pathetic videos where you have senior citizens and their only friend is a robot? I just think of that as my life. And then I'll say my best friend's a robot. They're kind of creepy looking too, aren't they? And so, yeah, so big issue for stock market. If you're an investor, these 3 numbers are extremely important to you because that's going to drive a big part of your return on the stock market. So historically, we've had a 4% dividend yield. What is it today? So today, you can just go into the Yahoo Finance. If you type in the SPY, which is essentially the stock market, and you look at its dividend yield, today it's 165. So historically it's been 4, today it's 165. So just that by itself means stocks returns should be 2% lower going forward than they are today. When we talk paper 3, we may need to make an adjustment for this because something major has happened in stock markets, and that's firms are actually now buying more of their stock back than they're paying dividends, and that we've never seen except in the last decade. So we'll talk about that. All right, I'll stop it there. I can kind of tell leaving noises. So, all right. A couple of things. I saw a few articles. Let me show y'all. This is what I may not show you the whole thing, but
That's a great resignation. You heard so much about it. Well, you're not going to find in the unemployment rate, which is before that year's record low. And we have a large number of Americans.
so this is before the Friday report, so you could actually use this.
Men in particular, men in the prime working years are actually not working, and they're not even looking for work. The result is a bit of mystery and also a major hole in the American economy. My name is Mike Rowe, and this is my job. Of all the jobs he's done over the past 20 years, and Mike Rowe has done all as a host of dirty jobs of discovery. He's never claimed to be an economist. But we'll take him serious during the Great Recession of 2008. He did notice something important. All anybody was talking about was the number of people who were out of work. But on dirty jobs, even then, everywhere we went, we saw all one size. It turns out dozens of real-life economists and other researchers have a possible explanation: a long-term decline in male labor force participation, or as one think tank summarized it, men not at work.
So, y'all might try to find this one out there. I saw it on Facebook. I thought it was interesting. Then there's a related article. Why are so many jobs going unfulfilled? So this is kind of interesting. The unemployment rate's really, really low. So you would think there'd be a lot of jobs not being filled, but then the participation rate's really low. You would think with all these unfilled jobs, the participation rate would go back up. People who gave up are now coming back in, but they're not. And it's a similar type of thing. We've got men and women who are sitting on the sidelines. The prime age male component labor force, men who've left the workforce and are not looking for work. Why is it? And they try to explain some of that. Here's that 7 million again. That's a lot of people. Here's 3.4. So we got more demand for labor than we have workers. Where are these workers? Where did they go? They're still out there. It's not like they all left the country or died or whatever. They're still out there. What are they doing? Tech companies are cutting jobs, but there are certain areas where they can't find workers, especially some of the retail areas just cannot find workers at all. I know several places. I have a guy who owns his own business. He's like, I can't find workers anywhere. No one will work. It's just impossible. It doesn't matter what I pay them. They just don't want to work. So there's certain areas that are really struggling. And then this was an interesting article. Here are 5 reasons the January jobs report may be too good to be true. So that's an article you might look up to. So what can you use in your paper? You should only use stuff that you could find Friday and before, because you're essentially writing on that Friday. But if you can find a good article that talks about stuff we knew before Friday, you can use that as input for your paper, as long as you're not talking about some new information that came out since the Friday. If you're commenting on the Friday, it's kind of like getting someone's commentary on the same thing you're writing on. They did it after Friday and you're doing it after Friday. So that is an issue. I ran some numbers similar to what they did in this article. So if you look at the participation rate, it was at 66%, and then it came down to 63 or 64 in COVID. Now it's at 62. So I just asked, what would our unemployment rate be if those missing people suddenly came back? And I got, if you go back to just pre-COVID, the unemployment rate would be close to 5%. If you go back to just a few years ago when it was at 66, the unemployment rate would be 8.7. So if those people rejoin the workforce, suddenly they're going to be, you assume they're out unemployed until they find a job, the unemployment rate would be much, much, much higher. So is it really 3.4? So you always have to think, you got it's a strange phenomenon. You got a low participation rate, you got a record number of unfilled jobs. You have big tech companies laying off people left and right, and Disney here is going to lay off some people. There's a lot of things going on, and it's almost like our economy is not in sync. Some areas are short workers, some areas have too many workers. So could this be, y'all probably learned this in your ecos class, structural unemployment. You have cyclical unemployment. And there's one other one that starts with an S. I can't, what was the other one? Structural, cyclical, or well, I don't know if it's seasonal. Yeah, I can't think of the other one, but so are we in a structural one? So there's a bunch of jobs that are unfilled because the people with those skills don't exist. There are a bunch of people unemployed because they don't have the right skills. Is it possible that our economy is changing so rapidly that we have the wrong skills? Is what? Frictional. That's what I wanted. Frictional. I thought it started with an S. So structural is there's just something wrong with our educational system. We're giving people the wrong skills. And how do you fix that? I think we have a problem with public education and with university level that we're teaching the wrong skills. And hopefully we'll fix that sometime in the next 100 years. But how do you handle that? How do you fix that? So part of my problem with public education is they have no incentives to fix it. Their incentives keep doing what they've always been doing because that's how they get paid. Universities the same way. Universities are focused on number of students, not on the quality of the education of students. I've been teaching here 20 something years and no one's ever come in and observed my teaching. And I don't know if anyone cares. I volunteered at an inner city high school for over a decade and heard some of the most horrible teaching I've ever heard in my life. I was kind of shocked, but the principal had no idea. She never visited the classrooms. It was just shocking to me. I had one kid who was college bound, really smart kid, but he's getting such awful education there. I was like, how do we catch him up and get him so he can actually go to college, huh?
They said that when the regular was going on, it's all mismatched. All these kids that are actually experienced like with quotas and times and all that, now they're all more lenient now, like talking to say do the work in the warehouse. Back then, it would be more strict on making time and making quota. Now they like we're all using knowledge now and they're all
Yeah, if you let down on the quality, so that that's the other issue. So yeah, it's frustrating for businesses to try to and they can't control it because so we talk in the US, we don't have a really good apprenticeship program, so maybe we need something like that. I think we need to completely tear down and rebuild public education and college education. But who knows what that new model is going to look like. Be interesting. You notice Google and firms like that are hiring non-college graduates now, and they're looking more for certification. So we may go to more of a certification route. Who knows? I've heard people complain that you don't go to college, get a job, go to college, get an education. But I mean, to get 16th century English lit, you can do that for free on YouTube if you want to do that. I've been watching art history class. You can do a lot of that education for free online, and then you can get a certification. So I'm not so sure. I'm not saying history and all that art is not important. It's really, really important stuff. But I'm not so sure our economy needs that. You can certainly teach yourself. But anyway, so there's something strange going on. I don't know which of these angles work, but think about it from your boss's standpoint. She's going to go meet with the CEO. She just had this report. Anything you can throw out there that's really interesting and insightful, it's going to make her look like a genius, which is exactly what you're trying to do. That's what she wants to do, is say, hey, while it looks really, really good, but we got some strange things going on in our economy. Blah, 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 that's the power of that little extra analysis insight that your boss wasn't expecting that really sets you apart. I don't know what that is. These are the ones I'm seeing out there. The JOLTS report, I haven't looked at the JOLTS in a while. I don't know when it even came out. So, those are available. You might look at that. It might be that it's a month old or whatever, but you can always put perspective into these. So there's something strange going on. You're trying to read people's insights. Make sure you're reading insights of people who know what they're talking about. So people who write articles for the press, like CNN and Yahoo Finance or whatever, they're not necessarily economists. They may be write articles more in that area, but they may not have that training. So, you're better off listening to economists, listening, especially the bond investors. So go to a major website for a bond investor. That's why I gave you Hoisington and why I think his stuff, and he hasn't written anything recently, so it'd be kind of a little out of date. But that's where I get excited when a student finds some insight that really adds to the analysis. All right. So that paper's due in a couple of weeks, right? 3 weeks or so. So one of y'all hopefully will volunteer and let me grade your paper in the class. We'll see. If not, I'll grade a previous semester's class paper. Okay. All right, we were talking about stocks before. So what am I looking for on stocks? So I want to just make sure you have a really clear understanding of how to discuss stocks. And this is going to be coming up again when we do paper 3 and 4. So when you talk about stocks, there's a few points I made. One was the expected return. That's very, very important. And then expected earnings growth, which is part of that expected return, and then expected economic growth. So this is all tied together with stocks. That's why the stock market reacts so strongly to economic data. The bond market reacts strongly because of what it will do to interest rates. The stock market reacts strongly because of what it's going to do to earnings growth. So I said the expected return on stocks is the current dividend yield plus expected earnings growth. Pretty basic, straightforward. I even gave you a chart to prove that. And it worked pretty well until 2008. Since 2008, the stock market's well above that line. And I gave you a couple of reasons why that might be. But I do think this is true with one caveat. That stock repurchases have become a major, major thing that they weren't 10 years ago. It used to be stock repurchases were less than stock issuance. And in that case, it just disappeared. Companies were issuing more than they were buying back until about, maybe it's more than a decade now, where stock repurchases net stock repurchases net of issuance versus repurchase actually was a higher number than dividends. Now, part of the challenge of that is it's fairly concentrated in a few industries, so it's not the entire stock market. But then the places that do a lot of stock repurchases don't pay dividends generally, so it's it's kind of all together. They're all paying cash somehow. So, do we make an adjustment for that? I have an article. We'll talk about it when we do paper 3 because it's important to paper 3. Should you make an adjustment for stock repurchases? In the chart I showed y'all, I did put something in there for stock repurchases. And it still didn't close the gap, so it doesn't explain everything. But you can, so I think of these two numbers are about the same. They're both about 1.5%, so it does add quite a bit to your expected return. The expected return on earnings should be a function of GDP, nominal growth. Corporate earnings should remain a fairly constant percentage of the overall economy. You shouldn't expect the economy to grow up 5% and corporate earnings grow up 20%. That would just be ridiculous. It could be 5 versus 5.2 or 6 versus 5.8, something like that, but they should grow about the same rate. So you can't say, wow, I really love stocks right now, but I think the US economy is going to be in a constant recession in the next 20 years. That's just not, that doesn't make sense. You can't get that. And expected economic growth is expected productivity growth plus expected labor growth plus expected inflation. I know imports and exports are in there. I just ignore those. They don't tend to be a huge part of that number. And we know that does bring it down a little bit. And I gave you some charts on that one. So when you do paper 3, you'll probably be using all of the charts I gave you. So this is my view of stocks, and I think it's a pretty decent view to have if you're going to talk to someone about stocks. Now, I'm not talking about a specific company. There are companies out there whose expected growth, earnings growth can be 47%. I'm talking about the overall stock market. Okay. That's going to be real critical in paper 3, especially because you're not looking at your company's growth, you're looking at the overall stock market to get the market risk premium. So the overall stock market's growth should be in line with the economy. When we talk about the stock market, though, if I'm talking about the S&P 500, that's only 500 companies out of several thousand. So it's possible that won't grow at the same rate as the economy because other companies may be growing faster or more slowly, and there's some private companies and that kind of thing. But I showed you a chart that it's not that radically different, especially here recently. The corporate earnings have caught up pretty dramatically. And so then what do you think about productivity? I showed you historically, it's ranged from 1 to 3%. This last decade, it's just been pathetic at 0.5%. Labor growth has been about 0.5 to 1.5%. Recently, it's been slow, especially 2000 to 2010. It's somewhat caught back up coming out, but still, we just saw that. We got baby boomers, we got people just leaving the workforce, we got immigration issues we need to fix. There's a lot of things going on with labor growth. And then this article here, was talking about, I forget where I read the article, but that AI is, it was another article, AI is going to replace 50% of the workforce. That seems a little strange to me, but y'all are sitting at such a different time. Obviously, when I was in college, it's like America's just lost it. We're done for. Japan's taking over the world. We're just not very smart. We're not going to do that's what we were getting in college. So you're in a country that's on its way down, and Japan's everybody's thinking, and do I move to Japan and try to make it there? And then Japan blew up in 1989. But you've got something very different. I was in a world that was changing because of computers, but it was to my advantage because boy, it helped me dramatically. I come out of school and all I got to do is learn Excel. If I learn Excel, I super pass up my bosses really fast because they're not learning Excel. All right. So what are you going to have? So what is it that's going to distinguish you from those people 10 years older than you? It's probably going to be Python, machine learning, AI, those type of things. But if you're not learning those things, that's where you're going to have difficulty keeping up. So for me, it was easy. Just learn Excel. I learned Excel really fast because Excel is pretty easy to learn. If I only had one thing to learn, don't you wish that's the only thing you had to worry about? Just learn Excel. But you got to learn Excel and machine learning and Python and AI and these other things as well. So your world's a little more complex. How do you do that? You make sure you have a job that uses that stuff. Don't pick a job where they've never used Python ever before. They've never used any kind of machine learning. Pick a job where they're doing that kind of stuff. So my first few bosses, really smart people, but they didn't know Excel. I wish I'd had bosses that were a little more intimidating, but fortunately it was easy. We just learned Excel. So your best bet is to find a boss that knows all of that and scares you to death, and you'll be fine because then you'll be scaring someone else to death 10 years later. But it's a very different world. There's so much stuff that's going on. So you're in a much bigger flux of change. And a lot of that's going to impact productivity. I don't know what ChatGPT is going to do. I had a friend who's an engineer, and I'm just shocked. They've stopped doing research. They just plug it into ChatGPT, and ChatGPT does all the research. So rather than going out researching, they just put it in there, and it gives them a paper, and that's what they need. And their bosses are fine with that. It's not like they're cheating. Y'all will be cheating, right? If y'all do it, because UTSA says you can't do that, but they're not cheating, and their bosses are fine with that. It's a bizarre world. So not to scare y'all, but better you than me, if anything. And so how does that affect labor growth? Are we actually going to need fewer workers in the future? That's part of the argument. 50% jobs disappear. Or is the type of workers we need going to radically change? And what does that mean? What skills do you need? And then inflation is inflation. So it's a tough thing. We're not talking about forecasting next year. We're talking about forecasting the next 50 years. Really, really tough thing to do. So I don't know if y'all have strong opinions on this yet. Ask, you're taking economics, aren't you? Macroeconomics, ask your economics professors. Where do you see productivity next 40 years and why? Where do you see labor growth next? What would you think they would say? Are y'all in economics right now? And you ask your professors. Now, if it's micro, they may not care, but if it's macro, they would. I wish I had Keith Phillips come talk to y'all. He's just a great economist here in town. And he studies this stuff quite heavily. So yeah, it's very important stuff. It's going to definitely drive your careers pretty dramatically. But that's how you bring it all in. That's what a stock is. That's what makes stocks so difficult, because you're not projecting out the next 5-10 years. Google stock, over half of Google's valuation is more than 75 years into the future. When you look at the present value. So how many of y'all can know what Google's going to look like in 75 years? I have no clue. I don't even know if they'll still be in business. They may be completely taken over. I hope they're out of business. I hope some better company comes along and takes them out, but who knows? So stocks are really tough, and it's getting more difficult because the world is changing so dramatically. All right. So with that there, so stocks have traditionally given us a 4% dividend yield. Today it's like 1.6, but if you add in the stock repurchases, we may not be too far off of that number. And then earnings growth has been about 6% historically to give us about a 10% return on stocks. Earnings growth is much lower now, probably because productivity is much lower today. So I would say, and we'll talk about this more on paper 3, I think any economic growth number between 4 and 6 seems reasonable to me. Below 4, you're pretty negative on the US economy. Above 6, I mean, how do you get above 6? I don't know how. You'd have to have like 3% productivity and 1% labor growth. And that seems, I don't even think the 1% labor growth is a pretty stretched number, given the baby boomers and what we're expecting. And the whole world's struggling with that. China and India maybe not, but China, Japan especially, and China, there's 1/5 of the world, 1/6 of the world right there. A problem with people aging and older generations and all that. So it's the labor growth is a problem around the world, and productivity is the one where, boy, it's really pretty uncertain. You hope it's really strong, because if it is, then you're going to be wealthy. But where's it going to come from? What's going to drive it? It's going to be, nuclear fusion. That would be pretty big, wouldn't it? Autonomous vehicles, that'd be pretty cool if we could, we just put it on our phone and this driverless vehicle comes up, picks up, takes us to the front door. Wouldn't you love to come right to the front door of UTSA? You don't have to park 3 miles away and walk. It'd be pretty cool. Or you go to the movies or whatever, and it drops you off right at the door, and you're driving to work, you're actually working, you're not sitting there in traffic. There's all these kind of things that could radically change our productivity, but which is it and how dramatic will it be? Where does productivity come from? Innovation, education, immigration, government regulations. In the US, immigration is a huge one. We say, half the new businesses in the United States were started by non-US born citizens. People from India and all over the world are starting a lot of businesses here. A good friend of mine here in town, very wealthy man. I forget how many businesses he started. Pretty amazing story. His son wrote a book. So I was reading his son's book and got the history of his parents. And it's like, wow, that was one incredible man to come here and to start from nothing. And he meets his wife online, and she comes over, and it's just like, yeah, that's the American story. And he created some pretty significant businesses and then started another one, just incredible. So immigration is a huge part of that. My biggest one is education. I think what we're doing right now is wrong, but I don't know the solution. I'm tempted to get a lot of students together and hear what y'all think should be. Do y'all think we're doing what we should be doing? I guess that's the question. Is this the perfect way to do college education? And if not, what would you change about it? So I don't know what the new model is going to be. I know public schools won't change real radically. So we have one former student who's trying to change that, and he's greatly hated by the teachers unions. I tell him he's got to watch out check his car for bombs every time he leaves because they really hate him, but he's causing some pretty significant waves. I'm not sure his solution is a good solution, but he's an awfully smart person and he's a UTSA grad. He might be Secretary of Education these days. He's making some waves. His whole thing is competition, which I agree with. I think we need more competition. But what is going to do that? Because that's really, really important. We know innovation in the US, we still have an advantage there. Silicon Valley types of places, US is still very, very good at pushing the envelope. Government regulations, we'll talk about that a little bit later. How easy is it to do business in the United States versus other countries? So I think that's still a little advantage of the US. It's still a disadvantage in a country like India where it's really tough to do anything. I do a lot of work in Costa Rica. It's horrible doing business in Costa Rica. Everything you want to do takes months and months and months and months. People don't show up, and it's just they could greatly increase the wealth of their citizens by just eliminating some just worthless regulations. So which countries? So this is part of where you want to invest. Which countries are strongest in innovation, education, immigration, government regulations, and then just cultural things. All right. So that's what a stock is. Any questions on stocks? When you're buying a stock, that's what you're after. You're looking way, way into the future. I was reading ARK. Y'all heard of ARK? The big investor. She has a disruptive, Kathy, what's her last name?
Happy with.
Woods, yeah. She has pretty interesting. Right now, she's got two companies. One does 3D printing with metal, and another one does 3D printing of human body parts. Those are pretty interesting things. The human body parts is pretty amazing what they're doing. So there are people. I have a high school kid I'm mentoring, and he wants to start that kind of fun. And so he's been reading what she's doing to see find something there that's going to take over the world. I mean, this is what you do as a stock investor. All right, so when you look at stocks, you have to do that big introduction because it's really important to understand this asset class. And then we get into the sub-asset classes, which I give you B, U, C, S, but I don't do it in that order. I do B, C, S, U, because US versus non-US, I like to do that last. So B is beta, C is capitalization, S is style, and U is US versus non-US. This is the traditional way of breaking up stocks. I'll show you some other approaches, but that is still the most traditional way. And so the B is what we call beta risk. And beta risk is not the same as the beta we're going to talk about with capital asset pricing model. Beta's gotten its own definition, its own meaning, much bigger than just the capital asset pricing model. What beta really means is how exposed are you to the overall market or to the economy? It's those very systematic types of risks. So the way to think about beta is what you think about the economy. Do you want to be highly exposed to the economy by investing in stocks, investing in those sectors that are very sensitive to the economy, or do you want to cut back your exposure to the economy by investing in bonds or investing in industries that are protected from the economy? Okay. So we break it up into cyclical and defensive stocks. Cyclical stocks have high betas. Defensive stocks have low betas. Which would you rather have if you expect a strong economy? Cyclical or defensive? Cyclical. Cyclical, you want high beta stocks. You expect a recession, you want a defensive stock. And just think about Walmart. Walmart, I don't know how many stocks were positive in 2008, but Walmart had a positive return in 2008. That's pretty remarkable that you could actually, beat a 35% down market, have a positive return. So cyclical stocks, high betas, retail, but especially higher end retail, Nordstrom's. Durable goods, cars, heavy equipment, planes, those type of goods like a Boeing. Commodities and materials tend to be extremely high beta. Concrete, steel, those type of businesses. Travel and leisure, obviously, an economy is doing weak or is weak. People aren't going to go on vacation. And business travel especially gets cut. And then consumer discretionary, which includes some of those we just talked about. These will have high betas, not equal. Some of these, like materials, tend to have higher betas than the others, but those are high beta types of sectors. These are the stocks you want to avoid if you're expecting a recession. Defensive stocks, the cheaper stores like Walmart, Costco, probably even Target a little bit. Target's kind of in between the two. Family Dollar is definitely. Gasoline, people tend to buy gasoline. Now, gasoline's a little tricky. If we go into recession, people aren't driving to work, so they buy less gasoline. So these aren't all perfect, but people do tend to buy gasoline even in a weak economy. Food, we do tend to buy food. We tend to buy more groceries than restaurants. So restaurants are kind of in between these two groups. Consumer staples, just by definition. Utilities, people pay for the utilities almost no matter what the economy is doing, especially in Texas when it gets hot. Telecom has traditionally been a low beta industry, but it's a little bit changing. You know, AT&T is a very different company today than it was 10 years ago. So telecom is somewhat getting into the media business, and media tends to be more high beta than low. Healthcare, we traditionally think of healthcare as low beta. Now you might say, well, people get their health insurance from their employers, so if people are losing their jobs, they're losing their healthcare. But healthcare, for most people, their healthcare is paid for by insurance, so they don't care. They're not paying for it, so they just buy it. If they're not feeling well, they go to the doctor, and they only have to pay a small out of pocket. Technology has been a tough one. When I started my career, is no question technology was high beta. But it's changed somewhat. There's some people who might replace their iPhone before they pay their utility bill. So some stuff has gotten a little bit, even Facebook for a while there, people would be cutting back on advertising, but not on Facebook. That's somewhat changing now. People are now saying, but at one point it's like, hey, you have to advertise on Facebook, but you can cut back on TV and radio and the other places. That seems to be changing now. So these are going through little waves that makes it a little bit difficult. I didn't put media up there, so actually Facebook is media, not technology, or Meta's media. So I'm not saying these are absolutely sure. The world changes. You notice I don't have financials up there. Banks and insurance companies, they're all over the place. They can be near one kind of betas. They can be, in the financial crisis, bank betas were 2.5, 2.6. They can be really, really high in a crisis. So some of these sectors, their exposure to the economy depends on why the economy is moving. What's causing the economy to move? Obviously, if you have a financial crisis, financials like banks and insurance companies are going to be the hardest hit. When you have a dot-com crisis, obviously tech companies are going to be the hardest hit. So there's nothing constant about this. It is something you have to kind of think through the different scenarios of what's going on, and the world changes. Technology is becoming more of a staple than it used to be. I'm not saying it is a staple, but technology is becoming more of a staple than it used to be. My first PC, I bought it from, I forget the name of the store. It doesn't exist anymore. It was in the mall. I bought a Tandy. I forgot who sold Tandies. But computer, $2,500. That was the PC, a dot matrix printer. The PC had no hard drive. I'm not saying $2,500 in today's dollars. It was $2,500 in the mid 80s. What is that today? Like $10,000. And no hard drive. If I wanted to load Lotus, I had to load 18 disks, one at a time, to load Lotus. Guess what I did with that PC when I was done with it? Put it in the dumpster. And it was not worth anything. So yeah, I mean, it's interesting the way the world changes now. My last PC I bought was a little laptop for $200, a million times more powerful than my first. Yeah, to me, that laptop was not a discretionary item. I had to have it. Whereas that first PC I bought, I was like the first person in the office to have a PC at home. My friends were like, wow, that's so cool. You got a PC at home and a dot matrix printer. Wow, you're so sophisticated. Like today, it just looks out of date. So you have to somewhat think through these a little differently. Maybe think about what economy you're actually expecting, but there's some general levels. So here's kind of the ranges I tend to think of. Energy, I think a little bit lower beta, just because we tend to drive a lot. Materials, high beta. Industrials, almost by definition, high beta. Communication services, it's all over the place. Kind of depends, because telecom is in there. Meta, Google are in there now. This is a new category. They took telecom and they converted the communication services, and they looked at Google and Meta and said, "Oh, these aren't tech companies; these are media companies. They advertise. Advertising, Meta doesn't make money from technology, or Google from technology. They make the revenue through advertising, and so they moved them to this category." Consumer discretionary and staples, are just the kind of the mirror image each other. Healthcare, financials tend to be in that 1 to 1.5, but they can certainly rise dramatically. Real estate tends to be medium to high. Utilities tends to be very, very low. I tend not to go betas below 0.4. Personally, I just think that's getting way too low. And I tend not to do betas above 3, but we'll talk about that on paper 3. That's going to be important, what you use. But those are the categories. I don't know why they broke out real estate. It used to be part of financials. It's just such a small part of the market. Now, real estate is the biggest part of the market if you include private real estate, but this is just publicly traded real estate, and that's just a small fraction. Now, I don't know what you do with BlackRock and these other companies that are buying all these houses. They're under financials, so even then you've got a mix throughout here. All right, so the tactical is pretty easy. You're expecting a recession, reduce your stocks overall and reduce the beta of your stock portfolio. Move out of high beta industries and move into low beta industries. Pretty straightforward. I can't imagine if you're in an interview and they say, "Hey, we expect a recession next year. What should we do?" "Oh, we should load up on stocks." I don't think most of y'all knew. I mean, all of y'all knew that before you started the class. But then you want to add in this idea of a beta. You want to move to more defensive industries, away from more cyclical industries. So very, very straightforward, very easy. If I trust this. So here are some returns by industry. I can't remember when I did this. It's maybe a few weeks old. But so in 2022, energy last year, thanks to Putin. In fact, I think there's one point it was between Exxon and Valero as for the highest returning stock in 2022. Those are two stocks that did how did they do in 2020? Pretty horrendous, right? When people stop driving, Valero is not going to do too well, but very, very strong comeback. Utilities did okay, and then everything else was down. And then 5 years, tech has been the big winner. 10 years, tech has been the big winner by far. Consumer discretionary has done extremely well, kind of interestingly. Consumer services looks bad, but it's not as bad as it looks. That's almost entirely Meta, because this is after Meta fell 70%. Now they come back up, they doubled in just the last few weeks. But at the point I did this, Meta was part of consumer services, and it was so big, right? It used to be $1 trillion company. It was so big when it fell 70%, it brought the entire industry down. So consumer services actually did a lot better than what it shows there. But you really just see that it's tech is what's been driving the market the last 10 years. And in energy here recently, which is, just a volatile thing that bounces back and forth. I don't even know this year. Boy, I haven't looked this year. It'd be interesting to see. So how I did this, you can create an Excel spreadsheet tied to Bloomberg. And just when you come in and update all these numbers automatically, it's something I love to do. It gives you somewhat of a dashboard. Say, hey, who's doing best? That way, when you go into an interview, you know which of these sectors is doing best. And that's something, especially if you're interviewing in an investment position, you want to know which industries are doing best. You could even do this on the fixed income side, on the bond side, which industries are doing best, where spreads So these are the kind of things you should try to set up in Excel, just so you kind of get used to building these type of things, these kind of dashboards, and then also just so you know what's doing the best. There's 25 years. They're, again, Meta by itself has really hurt that one. But you see 8 to 10% types of returns. Financials, 25 years includes 2008. That definitely, financials were permanently impacted. Banks used to trade at a 2-to-1 book ratio, price to book ratio. Now they're trading at a 1. So they're trading half of what they used to trade historically. So banks were permanently revalued down by 2008, and that definitely impacted it. It does matter which industry you pick, definitely. Now, should you go against here and everything that did well here, go under on everything that did badly, go over allocated? Maybe that would work. I don't know. 25 years is what? That's your age. Some of y'all, you haven't quite made 20. So during your lifetime, that's what the stock markets have done. What's gonna happen the next 25? I love this podcast. He said every successful company going forward will be a software company. If Ford is successful, it's because it's a good software company. If HEB is successful, it's because it's a good software company. I'm kind of impressed. HEB, when I go in there, I can't find something, I can click it on my phone and it tells me what aisle to go to. That's pretty cool, isn't it? Does Walmart have something like that? Y'all seen that? Do they similar kind of thing? I mean, that to me is pretty cool. So, you know, the technology there. I wish HEB, I think I've told somebody all this. I wish for the home delivery, they have everything I bought from them the last 10 years. I wish they would just create that as my shopping list and just send it to me off of my credit card bill. And then I could just edit what I don't and do one. I wish someone would create that software, because I hate going through their stupid website, trying to find substitutes for the stuff they don't have on their website. So there's more technology they could certainly do, but yeah, going forward, every successful company is going to be a software company, because that's how you contact your customers. All right, so that's beta, pretty straightforward. The second one is capitalization, which is simply the size of the firm. If any of y'all done Pharma French, the size of the company is one of the Pharma French models. We don't do that in here, but you'll see it a lot. So small companies tend to have higher returns than large companies because they're a little riskier. You know, that's the theory. So the categories traditionally are large cap, mid cap, and small cap. Those are the 3 categories. Some people include micro caps, and then very few, but I guess it's possible, some people will talk about penny stocks. But most people don't do. Penny stocks are essentially insolvent companies that are still trading just because they haven't been shut down yet. But micro cap, under 100 million, that's a really small company. That's a company USA could buy and you wouldn't even notice it in their cash flow. That's a small company. So large companies, I don't know where it starts because it changes all the time. To me, 20 billion is not quite a large cap anymore. Now, what's the largest company out there? Certainly not 20 billion. Y'all know the largest? Apple still is. Yeah. Well, I don't know if you include the Saudi Arabian oil company, but in the US at least, Apple's still 2.4 trillion. That's a big company. That's probably larger than the entire stock market was when I was in college. That's a huge company. 2.4. That's larger than a lot of economies, isn't it? Yeah. It's the same. It's the book value of the firm, but on a market value basis. So book value would be their GAAP net worth. Market cap is their net worth, but using current market prices. I'm sorry? Yeah, they probably update this every single day too. They should. I don't notice it changing during the day when the stock price is going up or down, but they should just change it regularly. You know, you have Microsoft used to be the largest, but it's certainly coming back. it's close to 2 trillion. I mean, it's interesting. Microsoft was by far the largest in the world. And it came off really fast. They essentially became has-beens. Why? Well, because we were using more laptops. We were using, Windows as operating system wasn't as much used, but Microsoft has really reinvented themselves. By far, the biggest tech stock, it wasn't even close, was IBM. There was a point where IBM wasn't just the largest tech company, but it was larger than all the others combined. But they're no longer a tech company. They're now essentially a consulting firm. So you can see how quickly the world can change. IBM is just not nearly as important as it used to be. Amazon is getting up there, $1 trillion. So you remember when Apple first hit $1 trillion, we're like, wow, that's incredible. Now we got a bunch of $1 trillion companies. And then you have some smaller companies. Sears is private. I think BBY is actually higher today than it was some time ago, a few weeks ago, but that's a $305 million company. That's pretty small. I don't know how large they were at their heyday. But
I think Tesla was going market cap and more, but I think they were.
yeah, Tesla has been coming up. I was trying to find a really good small company, but I can't think of one off the top of my head. There are some interesting ones that I find really fascinating that are doing new technology, but have almost no revenue, have nothing but losses. They're doing something. If it works, they're going to become a $1 trillion company. That may only be 1 in 1,000 chance, but hey, 1 in 1,000 chance, you buy 50 of them. If one of them is that 1 in 1,000, you make a fortune, and you can be wrong 49 times on the others. But who is that next company going to be? So, Moderna is interesting. It's 63 billion, but boy, you look at their COVID really helped them a lot. Since then, it's really fallen dramatically. Their PE ratio is really, 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 really low, but that's because their earnings are still reflecting all the vaccines. And so this is kind of a company that looks really cheap because unless we have another pandemic, they're like, what's our next big show? But this company was really expensive there for a while, was trading for almost 450 bucks. Now it's down to 164. I don't understand GameStop. This company is not worth $4 a share and it's trading for 20 something. So it makes no sense. Yeah, you can look at their really good earnings that they have. I'd say that tongue in cheek. When are they going to go profitable again? That's just, and their revenues are just not, it's just how y'all running out the GameStop now and using their service. I don't know how they compete against Microsoft and some of these others. It seems like they have a huge disadvantage, but they're still in business, and for some reason their stock price is still up there. So that's market cap. So why do we make this distinction? Why do we care if it's a large or small company? And the reason we care is we've noticed there's a difference in characteristics in these companies. Large companies tend to have more stable stock prices, but don't have as high of expected returns as small cap. Small cap are more sensitive to the economy, more volatile, but they tend to have higher returns. So there's a distinct difference between these. So we tend to break them up. This is pretty common. Small cap versus large cap is a fairly common approach. They are fairly highly correlated to each other. So you're not going to get much diversification by buying them, but you do have a risk difference. So if you're expecting a weak economy, then you want to get out of the small cap and move to the large cap. If you're expecting a strong economy, you'll probably want to do more small cap. So now you got to be careful on the exam, and we'll talk about this when we get to that second question. Say we're expecting a recession, you don't want to say over allocate large cap, under allocate small cap. What you want to say is within stocks, I want to have more large cap than small cap, because you're probably going to reduce both large and small cap if you expect a recession. You're just going to reduce small cap much more. All right, so you got to be careful. So if I say expect a recession, I'm going to reduce my stocks overall, but within stocks, I'm going to reduce small cap much more than I reduce large cap. I want to have a tilt toward large cap in a weak economy. Small cap can definitely go out of business in a weak economy. A lot of these are companies that their only hope is a strong economy, and so a weak economy can put them completely out of business. And it's pretty easy to buy small cap. You know, you go to Vanguard or BlackRock, they have small cap funds. It's really easy to buy these asset classes. So mid cap, for some reason, at the time I did this, mid cap had a pretty good run. Small cap has been doing really well. So, but you can tell, just look at 2020, they're much more volatile. Look at how much they fell versus the S&P. They are a much more volatile asset class, but they produced some pretty significant returns over the last several years. All right. Style. Are any questions on capitalization? I'm a huge fan of small cap value. We'll see how that does. They just look really cheap to me right now, but we'll see how that goes. Historically, small cap value has just been the most wonderful asset class until the last few years, when large cap growth just took over the world with all these large tech companies. But I'm back in the small cap value world. We'll see. Which brings up the next topic, which is style. You saw what I showed you with William Sharp, he distinguished on style. He talked about growth versus value. So even back then they were talking this. It was fairly new when he did it in that article. So value versus growth is probably 35, 40 years old. It's not, well, maybe, 35 years old. It hasn't been around that long. So what is a growth stock and what is a value stock, and why do we make these distinctions? So a growth stock either is a stock with high expected growth, or it might just be an expensive stock. You have to decide. It might be both. So we generally think of a stock with a high PE ratio or a high price to book ratio. Wow, it's an expensive stock because we expect it to grow really fast. So that's the general thought. So I just showed you Moderna, very, very low PE ratio, like it's 6. The stock market's at 20, their PE ratio is at 6. Why are they so cheap? Because you don't expect much growth, because they got so much out of the pandemic. If you look at a and what is GameStop's PE ratio? Well, they don't have one. Why don't they have a PE ratio? There's no E, right? You can have a PE ratio if your E is negative. But if you look at Amazon, PE ratio of 100, so you're paying $100 for $1 earnings. So if their earnings never grow again, it's going to take you 100 years to get your money back. So obviously you're expecting earnings growing really, really fast. You saw Moderna, Costco, company I love, but I think it's too expensive. Their PE ratio is 38. Spend $38 for $1 earnings. Does that mean they expect high growth? Well, there's 2 things that affect PE ratios: growth and risk. So Costco is either a high growth company or a low beta company. Right here, it's probably their low beta that's the most important. It's a very good defensive stock, but that 38 is a little extreme. You can compare them to, I don't know if I can do Family Dollar or not. We'll see. Yeah, you can't. Oh, I must have typed it wrong. I can never keep track of which of them is still public. So there's Walmart, 43, same type of thing. I don't feel as bad about Walmart as I do Costco. And if you look at EV to sales, you'll see why. Why is Walmart so expensive? High growth or low risk? Walmart has really proven itself as a low risk company. Whoops. Okay, which one is it? That should be illegal. ESPN does that as well. NVIDIA, PE ratio of 60. That's a fairly high, but not as high as it has been because Nvidia's price has adjusted somewhat. I was big in the meta there for a while. I've been cutting back, but their PE ratio got down to 10, and I thought, wow, that's really cheap for meta. That's kind of price, and their stock has doubled since then. So it's back up to 21, but still pretty low, right? I mean, their PE ratio is half of Walmart's. You expect Meta to grow faster than Walmart or not? No, it's kind of interesting. So the way we define growth and value, it's actually pretty straightforward. When Russell first came out with their index, they just took the entire stock market and they took price to book ratio and they just sorted them. High price to book ratio were growth companies, low price to book ratio value companies. That's the way to do it, pretty straightforward. The challenge we're having today is that several companies have bought so much of their stock back that they don't have any book value. Their book value is negative. You can't do a price to book. The reason you do price to book is everybody should have a number. Until here recently, we have firms like McDonald's, like Starbucks that have negative net worth. So I don't know how they're doing the ratios now. You know, PE ratios, a lot of firms have negative earnings, so you can't do them. So you're kind of running out of companies. You can't use EV to sales. We may talk about that one later. EV to sales, they're very different between different industries. So just because a firm has a high EV to sales, it doesn't mean they're expensive. It just may be in a different industry. So it's getting tougher how you define these companies. So the growth company has a high price to earnings ratio, which either means high expected growth or you're too expensive. Value stocks have low relative value ratios, either because they're cheap or they're expected to have really slow growth or both. Let me show you one that, I don't know, some of these I don't know if I can show you because I don't know what they've done recently. So Macy's is a good example. See if they have a PE ratio. So Macy's PE ratio, what is that? Is that value or growth? Value stock. That's a cheap stock. You're paying less than $5 for $1 earnings. If they don't increase their earnings any, you get all your money back in 5 years. So is Macy's so horrible that their earnings are going to keep falling year after year after year? What's the problem with Macy's? Well, they're in malls. When's the last time you went to a mall other than a La Cantera? Have y'all been to Ingram Mall? What's the one with the big boot? North Star. Have y'all been to North Star? I haven't been to North Star in probably 20 years. I used to go to Ingram somewhat, but is the Sears still open at Ingram?
Yeah.
Huh? I mean, this is nobody in it, but so their net income 846. They increased their net income. Oh, that's interest income. Excuse me. EBITDA loss gain doesn't look like a firm going out of business. They did lose a lot of money a few years ago, but you know, it was right in the middle of COVID kind of things. Yeah, this very cheap stock, or this is a company going out of business. And you have to kind of decide, but yeah, they're in malls. Now Nordstrom has done much better. I can never remember Nordstrom's. It's got a J in it somewhere for some reason. So Nordstrom's trading at 11. Nordstrom has a much stronger online presence, and they have those Nordstrom's rack or whatever that thing is. So either Nordstrom's a really bad buy and Macy's a really good buy, or Nordstrom's a better run company. And that's what you have to decide. Is it a value stock because it's in bad shape, or is it value stock because the stock market's mispricing it? And it could be both. All right, so you have to make a distinction between a good company versus a good stock. What's a good company? Profitable, growing, good returns on capital, low debt levels, predictable earnings. That's a good company. What's a good stock? It's cheap, right? Is it possible to be a bad company and a good stock? Absolutely. Is it possibly a good company, a bad stock? Kind of what I think Costco is. I think Costco is a great company. It's one of my favorite companies, but I think its stock is overpriced. Yeah. So you have to make that distinction. So Macy's could be a bad company and a good stock. Who knows? You know, it's up to you to decide. But right now, the market says there's something wrong with this company. Have y'all been in Macy's lately? Are any of y'all flocking to Macy's? Okay, well, I can't get to Macy's today. I gotta get there and buy there whatever they have. Or you walk in there as an empty store, or are there people in there buying stuff? That's what you're trying to figure out. All right, so here's the surprising thing. Growth stocks do better in weaker economies when interest rates are low. Value stocks do better in stronger economies when interest rates are rising. One thing to always remember is don't confuse the word value with the word quality. Value stocks are low quality companies. Okay. They're value stocks, they're cheap stocks because there's something wrong with them. They have too much debt, they've been losing money. So don't think value and quality. So value stocks are lower quality companies, growth stocks are higher quality companies. So what do you want in a recession? A low quality company or a high quality company? I'd rather have a high quality company. It's more likely to survive. Also, with growth stocks, because so much of their valuation is way out into the distant future because they're growing fast, higher interest rates tends to impact their valuations more than their value stocks. So that's the traditional. Now, I just read an article by GMO, says, yeah, that's your traditional approach. We don't agree with it, and they have a different slant on it. And the reason they have a different slant is not that they don't agree with the analysis, it's because I think value stocks are so ridiculously cheap right now that it almost doesn't matter recession or interest rates, value stocks are going to outperform because they're just really, really cheap. They say they're as cheap today as they were in 2000. You remember in 2000, growth stocks were just way up there with NASDAQ doing so well. So they're saying value stocks today are as good of a deal as they were in 2000 when you saw tech stocks sell off dramatically. So who knows, there's just some debate, but this is traditional approach. Growth stocks are better in weaker economies with lower interest rates. Value are better in stronger economies with higher interest rates. I didn't know this until we did analysis. I did analysis at USAA. I just wanted to confirm it. I was actually somewhat surprised that that was the relationship until you stop and think about it and say, okay, yeah, I kind of see that. Obviously, growth stocks up until the end of 2021, they were the place to be. Value stocks have done pretty well since then on a relative basis, although recently growth stocks have somewhat started coming back. So but you notice values did pretty well coming out of the 2000. Value did pretty well. And then here recently, growth has just really, really taken off. And that tends to be the cycle. So I like to actually graph these two and just see where they are relative to each other. So there's some reversion to the mean. If you go longer term history, you'll see kind of these 5 and 7 year cycles where one does well and the other one does well, and they just go back and forth. Right here, when growth had its big run, and it's a lot bigger than here. I should have used a log normal graph. This is a much bigger outperformance than here because it's it's almost 100%. There were people firing all their value managers and putting all their money in growth stocks. And I still remember right here, the sweet little lady at my church, she comes to me and says, Ron, my broker won't buy tech stocks. I keep telling him you got to buy tech stocks. And I told her, yeah, but tech stocks are like ridiculously expensive and overpriced. She looked at me like I was an idiot and kind of patted me on the head and said, okay, I'll go find someone who knows what they're talking about. I hope she didn't sell all her value stocks and buy growth stocks, but she was really mad. Another guy came to me and said, my brother wants to put my mom's money all in the tech stocks. She has Alzheimer's, she's in the nursing home. And I told him the same thing, tech stocks are really, really expensive. I mean, ridiculously expensive right now. Because yeah, my brother says anytime they fall, they always come back. It's like, yeah, that sounds like a good way to invest money. But I don't know what he did. Hopefully they didn't put all his, because he would have lost 80-something% of his money. So people, this right here was too much for people to take. And they got rid of the growth stock, the value stocks and back growth stocks, and then materially underperform coming out of it. So I like to look at the relative valuation. That's why I like that GMO article. They look at it and they say, right now, value stocks are about as cheap as they've ever been relative to growth stocks. So they're arguing it's a good time to get into value stocks. And then some people say, yeah, but if we have a recession, you don't want value stocks. And they say it doesn't matter. The mispricing is this much. You're better off just buying those value stocks. All right, questions on value versus style. So you can definitely see that I think we did this before, but I can't remember. We look at the contra fund. This is a mutual fund. We'll talk about mutual funds here pretty soon. But that's their style box. Have y'all seen a style box before? Have y'all heard the term style box? So what a style box means is it more value, growth? They call it blend. You may remember what word you use. You don't use blend. Value, growth, and core. Right. So core would be your balance between the two. So are you a value manager where you're buying cheap stocks that might have some trouble? Are you a growth person that you're buying expensive stocks but you just think they're going to do really, really well? Are you core manager where you're going to balance the two? So the fidelity is buying large companies, large cap, that are growth oriented. That's their style. How did Morningstar figure this out? Where they just took Fidelity's monthly returns and they correlated them against a core index, a value index, a growth index, a small cap, a large cap. And they said out of all the indices, large cap growth had the highest correlation to their fund. So pretty straightforward stuff to do. If I do a Vanguard 500. So what is the Vanguard 500? Large cap core. Why? Because it's the S&P 500. The S&P 500 is balanced. It's a little growthy, but not so growthy. So that you would expect that to be large cap core because it's S&P 500 index fund. If I do a Vanguard small value, nothing happens. I don't know the tickers for Vanguard small value, but it'd be right here. And that's that side. All right. So and this isn't an opinion. It's not like Morningstar is going, let's talk to the manager, figure out what they're doing. No, it's statistical. They just correlate the monthly returns against the indices and they find the one that matches the best and then they stick them in that style box. So pretty straightforward stuff. So questions on style? Not everybody believes in style. Some people say style is too limiting us. You know, if I like growth stocks, how about growth stocks? Probably the best example is Bill Miller. Y'all probably have heard of Bill Miller, not the barbecue guy, but he's at, I forget the firm he went to. Is it? That's not what I want. He's at not Bill Miller Barbecue. So I'm trying to figure out where he is. He's moved to a large firm and I can't remember. So, all right. Well, anyway, Bill Miller, he's famous for beating the S&P 500 15 years in a row. No one's ever done that before. Pretty amazing. What's even more amazing is he was a value manager. How in the world did a value manager beat the S&P 15 years in a row right in the middle of the .com? He should have grossly underperformed during the .com because he's a value manager. But before the .com started, he thought tech stocks were value stocks and he started buying them. And then at the top of the tech, he said there were growth stocks, so he got rid of them and bought value stocks. Incredible, really, really incredible that he did that. And then guess what he did the 3 years after that? disaster. Grossly underperformed, lost a lot of customers. He's at is it Leg Mason he's at? Boy, I can't find him.
Is that a another value fund?
I thought he was at Leg Mason, but I don't know where he is now. Oh, Leg has 2 letters in it. Here's his Wikipedia. It's an impressive firm. We interviewed his firm. I wasn't too impressed, but he wasn't the one talking. It was his staff, and they were saying stuff everybody else says. I wasn't too impressed. But then I heard Bill Miller on a podcast, and I thought it was quite impressive. He was talking the kind of stuff I thought was interesting. How do you beat the market 15 years in a row and then you mess up royally for 3 years? Well, he bet on energy at the wrong worst possible time. So, but he's classified as a value manager, and yet he was buying a bunch of tech stocks in 98, 99. And that's the only way he could beat the market that many years in a row, is he had to make some pretty radical shifts, because if you're always value or always growth, you're going to underperform the S&P 500 at some point. Impressive guy. I would encourage you, if you get him on YouTube or on a podcast, he's a really interesting character. He's getting up there in age. Yeah, he's 73, so he's getting up there, but definitely an impressive investor. So some people say, let's forget this value versus style thing. Just let people invest where it makes sense. But a lot of it is due to what William Sharp did with his style analysis, is that, you should hire a good growth manager, hire a good value manager, and they should stick to what they're doing. They shouldn't be flipping back and forth. So he kind of caused that. All right, then the last one is non-US stocks. So if we were to break the world up, it'd be in 4 categories. US stocks, and US stocks, that's beta, capitalization, and style. We can break US stocks into those categories. So you can have US large cap, value managers. Now, are value stocks low beta or high beta? It can be either. You can have value managers that are high beta. You can have value stocks that are low beta. So, you have to kind of break it into several categories here. Then you have developed market stocks. These are these large, more stable, developed countries. Emerging market stocks. These are fast-growing, developing markets. And in frontier markets, these are countries that something horrible is happening, but they do have a stock market. One good election, something interesting happens, and suddenly they could be the next place to be. But you could also lose all your money pretty quick, because these are the kind of countries where they nationalize everything. So everything you own suddenly is owned by the government. So pretty dangerous markets. I've never been a frontier market investor. I have done a lot of developing, emerging, but frontier markets, I don't know enough about those markets. Now, there's 2 types of investments. There's international stocks and there's global stocks. You want to know the difference in those 2. International stocks are stocks outside the United States. So if you buy an international stock portfolio, you only have non-US stocks in your portfolio. A global portfolio has everything, US and non-US. So if you see a mutual fund name with the word global, then it's probably going to be 40–50% US stocks. If you see a stock portfolio called XYZ international stock portfolio, it will not have any US stocks, all right? So global versus international. If you look at US versus developed markets, the returns, the risks, those type of things are real similar. The expected return, the big difference there is going to be some diversification with currencies and economies. So here this last year, I was showing the investment side last semester. Toyota stock did great last year. And yeah, it did terrible last year in US dollars. So there's a stock, up a bunch in a year when the US stock market was down. But if you bought Toyota stock last year, you would have lost money because the dollar strengthened so much against the yen. Now, if you hedged it, if you bought Toyota stock and shorted the yen, you would have gotten that 20-something% return that you could have gotten if you invested in yen in Japan. So currencies is pretty important. we'll get into this talking about currencies because it's a big issue. Do you hedge the currencies or not? And we'll just talk, most people don't hedge the currency. They just let it go wherever it's going to go. All right, we'll stop it there. We'll finish up this next class.